Good evening, everyone. Welcome to May's edition of All Access Belize. Your host is me. My name is David Kafka, and I am, as you know, the broker owner of Remax First Choice Belize and managing partner, co founder of Caribbean Capital Group, where we help people raise funds for passive income. And then Remax, we help people find their slice of heaven, whether it's active listings or, we'll, if you want to sell. I'm excited for tonight. We have a very exciting guest all the way from Keller, Texas, or the DFW area. His name is Mike Pine, and we'll have him introduce himself and kind of talk about him and what he does. And so tonight we want everybody to focus on asking questions on your tax questions. If you're a U.S. citizen and you want to buy property in Belize, or if you're even an investor in the U.S., how buying property and owning real estate or a real asset, it has some wonderful tax advantages. If you talk to Tom Wheelwright, he says just look at the tax code and they will tell you what to invest in. And so Mike is going to be kind of going over that. So let's introduce Mike Pine. And Mike, you tell us a little bit about yourself and your family and kind of what you do and how long you've been doing it, and then we'll kind of get right into some questions. And if you have questions, guys, we'd like to take the tax questions first, and then if we have time, we'll get into other questions. But we want to take advantage of his valuable time on taxes. So, Mike, tell us a little about yourself, sir.
Thank you, David. Thanks for having me here. So I am Mike Pine, a CPA. I am in my 21st year of practice. I have a beautiful family, as you can see in my backdrop. My backdrop might look almost as good as David's. I guess it depends on how you look at it. But I specialize in tax, especially on the real estate arena. And I chose that specialty because I am a firm believer that people should be able to keep what they earn. And I have no problem with people paying some tax, but they should not pay a single dollar more than they're required to pay. And as I learned more and more about the tax law, one of the best, if not absolutely the best tax advantages you can find in tax optimization strategies is real estate. Mainly on the rental side, and owning the real estate to rent it, you get some incredible tax deductions. I think the New York Times recently released at least parts of ex-President Donald Trump's tax returns, and for 15 years he hadn't paid tax. He's not cheating the system, he's following the system. As David mentioned and Wheelwright talks about, the tax code is an entire set of incentives for the nation that Congress has come up with and wants people to follow and do to help improve our economy, help create affordable housing. And by doing so, they give you great tax deductions and great tax benefits. I also call the tax code the yellow brick road. If you follow the tax code, you can find yourself into independent wealthiness much faster, and even make it more possible than if you don't. So 99.5% of the tax code is all about tax deductions, tax credits. Only one small portion, less than 1/2 of 1%, actually levies tax. So I love that tax code. I know it's a bit of I'm a bit of a nerd, but honestly, it is one of the best places to increase your rate of return on investments by utilizing the tax code. So if you can get tax-free distributions in a real estate entity, even if you thought you were getting a 12 or 14% rate of return, you get tax-free, you're immediately increasing your rate of return by 33% or more, depending on what tax rate you're paying. So that's what I do and why I focus on real estate. We've got a firm of 19 people here now in Keller, Texas. We're opening an office in Roanoke, Texas as well. And I'd say fully half of our client base is in the real estate arena, whether it's short-term rentals, long-term rentals, just somewhere in real estate. A lot of them are in syndications. We've got a lot of syndicators that we do the tax planning for and tax work for. So that's who I am and what we do.
Very good. Great. Thank you so much for that. And also, I'm sorry, Sarah, I wanted to definitely introduce you. Sarah's she's on our team, and she's helped running the webinar. And so all your questions, just chat them in the question and answer box, and throughout the night, she'll be probably adding some polls and things like that. And tonight we're going to give away an ounce of silver. So we're going to do that. It'll be coming from Dana Samuelson, who is in Austin, Texas, and he's who I buy my gold and silver from. So again, thanks, Mike, for being here, Sarah for being here, and Matthias, thank you again for joining. And he has a question that I only buy land in Belize, but don't build for a couple of years. Are there any tax consequences or benefits?
So let me ask you, David, is there property tax in Belize?
There is property tax. Matthias, I'm not sure. He's either looking at Ambergris Caye or Placencia.
Okay.
And whether, it doesn't matter where in Belize, it's all pretty reasonable. My house here in Placencia, where I'm at, is 27 Belize dollars a year. My house in Ambergris Caye is 130 Belize dollars a year.
Incredible.
So he's looking at Placencia, he just said. So that would be it. And that's really only tax in Belize, but I don't know if there's anything he can claim in the US.
Yeah, so the advantage of owning any type of rental property, again, whether it's short-term or long-term, is the deductions you get to claim. So if you don't have a building yet, you aren't getting this amazing thing called depreciation. Depreciation is this magic tax deduction that really, you're not spending any additional money. You're not losing anything in your assets. Your assets are going up in value, but you get these incredible tax deductions. But you don't get to depreciate land. So land is not depreciable. If you buy an investment property, or whether it's for an investment or to eventually operate as a rental, you do have interest expense if you're mortgaging it. So you would get to deduct that, but you really don't. The great benefits don't start kicking in until you have put in service a building that we can take accelerated depreciation on. And if now's a good time, I'll get into that, David. What do you think?
Yeah, man, go right ahead.
So again, one of the best reasons you would invest in real estate or operate real estate, if it's just an investment property that you're going to use as a vacation home only for yourself, you don't get a ton of tax advantages from it. But again, except maybe additional interest expense on your personal return. But if you do get a rental property, short-term, long-term rentals, that property depreciates according to the IRS. In reality, it's going up in value. Everywhere property goes up in value. There might be some years where it goes down for a while, but over time, all property goes up, all buildings go up in value. So in reality, you buy an asset that's going up in value, but the IRS lets you recover the cost of that asset over a period of years. If it's residential real estate, it's 27 and a half years you can deduct it over. And you would say, that's not a lot. You get 1/27th a year of what I pay for a property. And that's right, it's not a lot, but there's this beautiful thing called accelerated depreciation, where you get an engineer, they do this thing called a cost segregation study, and they found out, yeah, the house, it's got a 27.5-year life, but there's so many things in that house, like the HVAC ducting and plumbing and the wiring and the fixtures and the furniture and the flooring, the counters, appliances, all those things have a much shorter life. They have a 5-year life or a 7-year life. And according to current tax law, and we'll see what it is next year, but if no new tax laws change all the way up until 2022, you get this awesome thing called bonus depreciation. So all that property and that you can segregate from the house itself, you can take 100% deduction on whatever the value that is in the first year of operations. So a typical house, let's just throw some money out there, if you pay $100,000 on it, It's worth $100,000 when you buy it. You can get $30,000 to $35,000 of an immediate deduction doing a cost segregation and taking this bonus depreciation. We don't anticipate that to last past 2022 with the current Congress, but even so, then you still get to depreciate that $30,000 over 5 years or 7 years, maybe even over a little shorter period. So,
Sorry, guys.
no problem. So that is the beauty of investing in real estate property that's income producing. And it can either be a long-term rental or a short-term rental. If you can work it right, you can use that depreciation of those deductions to offset income from other sources, whether it's your W-2 income, your other business's income, regardless, it could be capital gain income. You can get this huge net loss in your first year of operations, your first few years of operations, and reduce the other income. But there's a trick. There's only two ways of being able to do that. One is you either have to be a real estate professional, which is a high hurdle to achieve unless you happen to be a realtor like David. And just a quick summary of that is you have to have 750 hours or more of qualifying real estate professional activities during the year. And you can't do anything, you can't spend any more time on any other business besides real estate. But if you're a real estate professional, then all long-term rentals, you can utilize their losses to offset any other income you have. But there's another better one, I think, and easier to achieve, and it's for short-term rentals. And the difference, according to the IRS, the difference between short-term and long-term rentals is a 7-day mark. If your average lease over the year, lease length is less than 7 days, it's a short-term rental. It's not considered a rental property. It's just considered an active trader business. If that's the case, then all you have to do is materially participate according to the IRS, which is a much easier hurdle to get to. In some cases, you can do it just by spending 100 years or more on that property. In some cases even less, but I prefer to be as bulletproof as possible with the IRS. So at least 100 hours or more. In a perfect world, you spend 500 hours or more on short-term rentals in an aggregate in total, and you become an active trader business person that's materially participating, and then you can get those depreciation deductions and offset income from any other source. And it's just incredible, incredible tax deduction. So depreciation is really the name of the game when it comes to real estate for tax planning purposes.
Man, awesome. All right, let's, Jared, welcome, buddy. So Jared's asking if we own rental properties outside the USA and we keep the income overseas without repatriating it, are we still taxed under the US law since we reside in the USA? So yes. I think I know that answer, but I will let you answer that.
David, you know it very intimately, maybe as well as I do. As a U.S. resident or U.S. citizen or U.S. tax-paying resident, you're taxed on your worldwide income. You could exclude a certain amount of foreign earned income. I think this year is around $108,000. It goes up every year for inflation adjustments. But the first $108,000 of foreign earned income, you don't pay any U.S. tax on. Anything over and above that, you do have to report as taxable income. And since Belize doesn't charge any income tax, is my understanding, then you don't get what's called a foreign tax credit. So you would pay tax on the income above that. But again, that's where the beauty of depreciation comes in. If you're doing it right and you're continuing to grow your real estate portfolio, you should be able to make it to where you're never paying taxable income, or at least on your rental properties. So yes, you would have to pay some tax on that.
And we do pay like 1.75% in our, I guess what you would call income tax. It's okay. On the gross. It's a flat tax. There's no deduction. So whether you're making money, losing money, it's 1.75%. There is no capital gains tax, but if you're an American citizen, there is capital gains in the US. Now, what about, let's say I'm the property manager and I manage the property, and Jared, I'm managing Jared's property, and it goes into my escrow account or my business account, and I hold it for him, but it doesn't go to him yet. Does he have to pay taxes on that?
There's a big perhaps is the answer. So the way the IRS would say it, their rules are, if he has constructive receipt, meaning he can tell you, hey, I want that money in my account today, If he has the ability to do that, then it's earned income to him and he should be taxed on it. If there's some contingency that it might not be his, or he has to wait a certain amount of time, then there are ways to not recognize it as taxable income that year.
Gotcha. Okay, very good. Well, Matthias wants a follow-up question. What accounts as land improvements? So if he adds like a septic tank or utilities or things like that, what entitles that as far as tax deductions?
Gotcha. So as of 2017, that's called qualified improvement property. It has a 15-year life, which is applicable to take the bonus depreciation off of now. If they get rid of bonus depreciation and don't change the law like they did in 17 to call that 15-year property, then you get to take it over 15 years.
Okay, very good. Kelly is asking a question. Hey, buddy, how are you, sir? Thanks for joining. Does UBIT tax-free impact the real estate investor, the debt portion of a project? Does UBIT have an effect on this? How much? And can you explain how that may have an impact?
Leave it to good old Kelly Fisher to throw out a question about UBIT. So UBIT is unrelated business income tax based on unrelated business taxable income. It only applies to qualified retirement accounts. So accounts that are allowed to grow tax-free in the US, like IRAs or 401ks. They have this deal that says any kind of unrelated business income that any of their investments earn and they directly can collect might be taxable. When it comes to real estate, the big issue is, and Kelly must be very aware of it, is debt financed real property. A portion of that a portion of that is considered UBIT. And in theory, and technically, you should pay tax on it. I'm not saying don't pay tax. I think you should pay every dollar you're legally obligated to pay. But right now, like we see all the real estate syndications here in the US that have a ton of IRAs and 401ks invested in them through self-directed accounts. They get a K1. The K1 actually goes to the fiduciary, the nominee who's holding that 401k money or that IRA money, and they're supposed to file a Form 5500 and recognize the UBIT tax and report it. Does it always happen? Rarely does it happen, but I'll tell you the IRS for over 6 years now has been threatening that they're going to start cracking down on it. So just to give you an example, Kelly, let's say you buy $1 million property. 500,000 of it is leveraged. The other 500 you pay cash. You're 50% leveraged. So in theory, 50% of any net taxable income is subject to UBIT. But again, depreciation plays a huge role, because if you have enough depreciation to offset the taxable income to where you don't have net taxable income, you have a net loss or operating at break even, then there's no UBIT and you don't have to worry about it. Does that kind of answer your question?
Yeah, man, very good. And I might add, you can always, talk to Damian Lupo with the EQRP, and with the EQRP, there is no UBIT tax. So, that might be a way to go to kind of get rid of that. Is that your understanding too, Mike?
That is my understanding. It's pretty impressive product that he's come up with using the statutory trusts and stuff that based on current tax law, they don't have to pay it.
Right. Very good. Owen, welcome, buddy. Thank you for joining. Is there a tax advantage buying Belize real estate through an IBC or an international business corporation?
I like to stay away, and this is just my personal preference, because corporations if you own anything through a corporation, you're likely going to be subject to certain double taxation. The corporations, unless it's an S corporation, has to pay tax. And then if you want to pull anything out of it, you have to pay tax. So honestly, I don't recommend them to own, like if you're going to go buy a rental property or a vacation rental in Belize, I think you're better off doing it through some type of pass-through tax-free entity. So you're not going to be subject to double taxation. And hopefully, if you go in the international business corporation, those don't get that foreign earned income exclusion every year. So I recommend, again, not to use those unless you get so huge. Then there might be some benefits. If you have, millions and millions and millions in your portfolio, then it's something you might want to consider. And the rules with those get a lot more complex.
Gotcha. But now, if the IBC is in a jurisdiction that does not have income tax, it's only taxed from the U.S., correct?
Correct. And a lot of people have done this. They try to shift the profits into the foreign branch and the non-U.S. branch versus having it be U.S. income. And in the past, people have gotten away with that a lot, but the IRS has cracked down. They've written these new laws. Just a year ago, they passed another new law that's trying, the one that tried to give people a benefit to repatriate money earned in a foreign jurisdiction. When they wrote that wonderful new law, which sounded great, it also had a lot of new taxes that didn't allow people to move money to foreign branches, and they come up with foreign branch tax. And so, yeah, the foreign jurisdiction wouldn't necessarily assess any tax, but the U.S. is going to try to get its piece.
Yeah, for sure. And we're not trying to advocate not paying taxes. We're just trying to how to legally reduce your tax rate. My understanding is an IBC is more for a, you don't have to pay the Belize stamp duty because you're not transferring the title, you're transferring the shareholders, and also it's for privacy protection. And we're working on trying to get a privacy protection or an asset protection lawyer on in a few months. And then we'll probably address those questions as well. So Kelly's asking a follow-up question. Is there any advantage for a U.S. resident to invest in Belize, bonus depreciation, etc.?
Right now, the way the law stands, yes, you still get bonus depreciation even on a foreign purchased asset. It wasn't that way a couple of years ago. It probably won't be that way a couple of years from now or even in 2022. But if you were to buy it in 2021 and Congress doesn't pass a retroactive tax law change, which in all historically speaking, they've never raised taxes retroactively. They've reduced taxes retroactively, but they never raised it. So most likely you're good if you do it in 2021, Kelly.
Very good. And then is he a real estate professional because he's a builder developer?
He could be. I can't share Kelly's. I do his work, his tax work, so that's confidential. If he wants to share it, he can. But he certainly could be, because being a real estate developer is a qualified real estate professional activity, as long as he does it for 750 hours or more and doesn't have any other type of business that's non-real estate related that he spends time on. Absolutely could qualify.
Okay. So what about Mike, like my buddy that I want to introduce you to, Art? He's a fireman, and he works 2 days straight, and then he has 4 days off. So he could actually qualify hour-wise as a real estate professional, but he's still a fireman. And
Yes.
as everyone knows, I was a fireman, and we all have to work part-time jobs, and a lot of them are real estate professionals. Can they still qualify as a real estate professional even though they have a W-2?
Yes, as long as they spend more time doing the real estate than they do doing the other job. So the IRS, the way that would work out, and I've seen it, there was 2 court cases very similar. One was with a nurse that worked 220, she was on 2 days on and 5 days off, but the IRS considered her being on call for 24 hours both those days. So they said she worked 48 hours. I think she should have appealed it, because no one works 24 hours straight. So, but the IRS wants to see actual hours. And if you are going to claim real estate professional, or if you're going to claim material participation for short-term rentals, I strongly, strongly recommend that you keep track of your hours. You can use a spreadsheet, you can keep a logbook. I love an app called T-Sheets for timesheets. It's really easy to record your time, and you do it in real time. And I've used it against the IRS in an audit, and it blew the IRS away. And the arguments didn't hold any water, because we had all the proof right there with all kinds of metadata. But as long as your buddy proves that, hey, he spent more time, not only did he spend 750 hours in real estate, but he spent more time doing that than as a W-2 firefighter, then absolutely you can. And there are some W-2 taxpayers that also qualify just from their W-2 jobs as real estate professionals. If you're involved in the managerial decisions of any business that's a qualified real estate business, like a construction company, you probably are a real estate professional and you just don't know it. So even there's a case for an accountant, and I love this case because I'm an accountant and I want to be a real estate professional too, but where there was an accountant that worked at a property management company and they claimed real estate professional status. The IRS came back and argued with them and said, no, you're just an accountant. And they got the bosses in there and said, no, she's very much involved in making managerial decisions on our operations, so she qualified and she was a real estate professional as well. That being said, if you can't qualify for real estate professional, and if your spouse can't, which is another way a lot of people do it, if one spouse is working part-time, one spouse is working full-time, the part-time spouse can make real estate professional. But let's assume you can't qualify as a real estate professional. Well, then there's this great, it's called the Airbnb exclusion, or that's what we CPAs call it short term. There's this great rule that says, if it's less than 7 days on average or leases during the year, it's not a real property trade or business. And as long as you can materially participate, again, that's a much lower hurdle. Spouses can combine their time as long as they can materially participate. And I'll go into those rules in a little bit more detail here in a minute. But they still get the same benefits as if it was a long-term rental and they were a real estate professional. It's just so much easier to do it. The problem is if you have people that want to rent your house for a month at a time, I mean, that's good money, right? You want that kind of booking, but you have to make sure and manage that your average lease length over the year is less than 7 days. So that's a great way, and I think that's something maybe your firefighter buddy might be interested in too if he's working 224s.
Yeah.
The one thing I would warn people about is you can't mix those two buckets. So if you qualify as a material participant in short-term rentals, and you spend 500 hours a year doing that, you can't use any of those same 500 hours to try to qualify as a real estate professional. You can do both, but you have to qualify for both on your own merits for both of the avenues of the tax deductions.
Very good. And I know, like myself, I use Clockify, and Toggle is one that OTS uses, and Organized to Scale is a company that helps me. They're part of my team. Sarah works with them, and they use Toggle, and so we're looking at maybe switching to Toggle. But again, it's easy to track your time doing whatever you're doing. So, and then like Mike said, T-sheets. So Jeff is saying there is a lot right next to mine in the Placencia area that is currently being rented out by a family who isn't using it, and I noticed they haven't paid rent in over 10 years. It's in a sad state of repair. Is there a way to purchase that land, which is next to mine, directly from the government of Belize, so I can develop the lot along with mine? Jeff, if it's owned by another person, you can't. The government of Belize it's one of the things with the country of Belize, it's very strong property rights. That's why it's a great country to invest in. You have the same property rights as a Belizean. And so as long as that person owns the land, they have title to it, you have to buy it from them. So if you can, maybe somehow talk to that or reach out to me online, and we can see if we can know the owner, we can approach them. And in my opinion, there's always a price. Everything's for sale. So, it might be for sale. So thank you for that. Fern's asking, Mike, if any of what we're talking about applies to Canadians.
I'm not an expert on Canadian tax, so I'd have to just honestly say I don't know. I know they have depreciation in Canada. I think it's harder to get accelerated depreciation, but I've had some clients that have moved from Canada and one that moved too that are in real estate, and I think there still are tax benefits in real estate, but I don't know what they are.
Yeah, and my understanding is, Fern, that there is some, but it is different. Like your worldwide income, you can use the deductions. Again, you want to talk with your Canadian professional And if you have a good CPA that's knowledgeable about real estate in Canada, let me know. We'll bring them on because we do have a lot of Canadians that are our clients and are interested in this. And of course, this podcast is for informational purposes. So Steve's asking, are the depreciation and deductions that you're referencing applicable in a foreign country? So yes, it is
Yes.
applicable in a foreign country and in the US. So being a US citizen, you can take these deductions anywhere. That's why it's, if you want to put paradise in your portfolio, place to, because you do get same tax deductions. Anything you want to add to that, Mike?
Yeah, I mean, it's changed over time, the type of deductions you can get. Like right now, the big golden nugget is the bonus depreciation, being able to take that huge deduction in the first year. Up before the 2017 tax law, they did have a bonus depreciation. It wasn't 100%, but it was still a great percentage. But it didn't apply for assets placed in service outside of the US. They could apply something like that in the new law, or create a new law similar to that. That being said, you were always still able to depreciate it. So you might not get that immediate first year deduction that you can get right now, but you could still get to deduct it. And if you did that cost segregation that I mentioned, you'd be able to still reduce your income significantly over 5 years or 7 years.
Great. All right. Thank you. John's asking, what taxes would I be looking forward to paying as I set up a Belize corporation specifically for the task of crowdfunding an island there? And what would be micro investors need to expect? Is there a specific way to set up that for a maximum benefit?
So the question involves setting up a business in Belize, like creating a Belizean Inc.
Yeah, I think John, the way I understand it is, um, a lot of the stuff that you're talking about, crowdfunding, it depends on where you're raising the funds. If you're going after U.S. investors, then you're going to have to have, some like a private placement memorandum and things like that. The property can be owned by a Belize corporation, or a Chapter 250 is what we call it. But all the taxes are still, applied, here in Belize. And it depends, I guess, too, on where the GPs or the general partners are, or the limited partners. But you're definitely going to want to, if you're raising funds from Canadian investors, you're going to want to seek a securities lawyer in Canada. If you're raising funds again from US people, you're going to want to talk to a securities lawyer. And Sarah can type in Mauricio's email. That's who we use. And, kind of good luck with that, and happy to answer any questions for that. And also, Sarah, if you want to pop up a poll, we have a couple polls on how we can get better, and what you're interested in, so we can bring that to you. We'll have a couple throughout the rest of the night. We're about halfway done, so keep the good questions coming in. David's asking, if one were to relocate to Belize and own rental property for income, but maintain U.S. citizenship, would I be subject to IRS taxes even though I don't live in the U.S.? So yeah, David, let's have Mike answer that, because that's basically what I do. I am a U.S. citizen and I'm a Belize citizen. So Mike, you want to take that?
Yeah, and David, again, that's a great question. I'll be honest with you, my wife and I have been daydreaming about doing the exact same thing at some point in the future. As long as you maintain your U.S. citizenship, you are taxed on your worldwide income and supposed to file taxes and pay income tax. And in a lot of cases, people that don't, they get away with it because they never get caught. But the ones that do get caught, man, do they slam them bad. So I'd recommend filing it. The cool thing is if you go and you retire right now, and again, it's indexed for inflation, so it goes up, but at $108,000 or $110,000 of net income each year that you earn in a foreign country is tax-free. It's the foreign earned income exclusion. You don't have to pay tax. You report it in the US, but you don't pay taxes on it. Anything above that, then you would have to pay some tax on. But if you figured it out and try to do the balancing act, depending on what your needs were for retirement, if you could keep that reportable income amount each year below the foreign earned income exclusion, you could avoid paying any taxes legally. And you can shift income from one year to another. There's a lot of ways to do that. So if you had one high year, one low year, you can do that kind of balancing act to try to maximize that exclusion.
Now, anything over that, Mike, you still get to use deductions, right? So if
Oh,
you make
absolutely.
$175,000 and you have deductions to bring it below 108, then you're paying no tax, correct?
Right, exactly. So the foreign earned income exclusion is your net income, all of your revenue minus all of your expenses and your tax deductions, which includes depreciation plus every other reasonable cost you spend to operate the business, which can be travel, it can be literally anything that you need to do to keep that business up and running is an ordinary and necessary expense according to the IRS, and you're allowed to expense it, and you certainly should.
Yep, exactly. And when you pay taxes in Belize, you report that to the US as well. And my understanding is the US gives you dollar for dollar credit.
Yeah.
So if you're paying, I pay 15% tax for real estate. And so if I make $15,000, I get to, not depreciate, but I get to offset my tax in the US for that. So most of the time, you're not going to have to pay, but it's just the fact that it is kind of a pain that you have to report it. Plus, you have to report any businesses you own or that you're a signer on, and any bank accounts on an FBAR. Is that correct, Mike?
That's definitely correct. Something you have to do. You don't necessarily have to pay tax by owning foreign bank accounts, but any bank account as a U.S. citizen or U.S. taxpayer that's in a foreign jurisdiction that has an average balance of over $10,000 or at any time during the year over $10,000, you have to report that or you get slapped with a $10,000 fine if they catch it. So it's really an informational return. And just to expand a little bit more on the foreign tax credit that you mentioned, so as a U.S. citizen, you were required to compute your U.S. taxable income if you have any, and then they assess the tax based on that. But like David said, any foreign tax that you've paid, you get a credit for it. So if you end up owing $1,000 in U.S. tax, but you already paid $900 in foreign jurisdiction, you only owe $100 tax. They give you credit for paying that foreign tax.
All right, very good. Good questions, guys. So Missy's asking, is a short-term rental a Schedule C income as opposed to long-term rental Schedule E? If so, is it subject to Social Security, Medicare taxes?
Great question. And the answer is it's pretty much a gray area. If you're doing a short-term rental that you want to utilize to do the material participation, so you can take net taxable losses and offset other income, you want to report it on Schedule C. But by reporting on Schedule C, if you end up making taxable income, then you're going to pay Social Security and FICA taxes on it, or potentially self-employment taxes, only if you have a net taxable income. Well, what we've seen and we've done, and there's no law against it, is in the year that you have a loss, and it happens a lot, where you might go and renovate this vacation rental and spend 500-600 hours getting it done that year, and you are a material participant, and that's, you report it as a Schedule C business. It's just an active trader business, and you get the huge deductions that first year and use that to offset your other income. Well, the next year you might have someone else manage it and not qualify as a material participant. So then at that point it's more appropriate to put it on Schedule E, and we put it back and forth. If based on your specific facts and circumstances, I can't tell you what the best thing to do is, because if you're taking huge deductions year after year on one Schedule C and then each year after that moving it to Schedule E, it could open yourself up to some IRS scrutiny. You would not necessarily lose against the IRS, but it's better not to tangle with the IRS if you can avoid it. So we always think about that when we recommend how to file certain ways.
Great question. Ken's asking, his cost segregation consultant told him that bonus depreciation doesn't apply to offshore real estate investments, which also use slower alternative depreciation method. Is that correct?
that was correct and will be correct again, but not currently right now. So again, the bonus depreciation, the new laws allows you to deduct it now, whether it's foreign or not. But even if once we lose the bonus depreciation, or if they take that allowance away for foreign purchased assets, then you still get the additional accelerated depreciation. So under the old rules, if you had $100,000 that could have been deducted as bonus depreciation, but because it was foreign and was disallowed at that time, you could still take it over 5 years instead of the 27.5 years. So even though bonus is better, it's still good to do the cost segregation if you don't qualify for bonus in the future, which most likely is going to be the case on foreign earned property.
Yeah, and I've talked to a couple consultants as well, and they all told me you can do it in Belize. You just have to follow the rules, and you might have to bring somebody in to make it, qualify. So Hayes is, as a U.S. citizen, is it best to own Belize property in an LLC? If so, what are the pros and cons? Hayes, I guess I'm gonna say that it depends on what you do, or what like what do you do for, if you're a litigious business, or I own all my properties in a U.S. LLC or a Belize LLC. And so it just kind of really depends on your asset protection and what your accountant, wants you to do. What do you say, Mike?
From a tax standpoint, it's really 6 of one, half a dozen the other. As long as you don't like make an election to have an LLC tax as a corporation, which you could do, and I wouldn't recommend that in most cases, it doesn't really make that big of a difference for tax purposes. It makes no difference. It is a legal liability issue that I'm not an attorney, I'm not licensed, I'm not allowed to offer legal advice. And you'll hear attorneys say the same thing about tax, and you just have to work with both an attorney and a CPA. But like David said, it's a liability question, and attorneys usually recommend that if there's any type of liability hanging out there, like you can get sued if you've got a vacation rental, someone goes in and falls through a floorboard or slips and falls, and somehow some jury awards them more money than you have insurance for, then they could potentially attack you, and that's why you should consult with an attorney before you buy in it or invest in any type of asset that might have legal liability attached to it.
Yeah, very good. Matthias is asking travel question. We're both fully COVID vaccinated. Do we need COVID tests for airlines to enter Belize and the USA? You do not need a COVID test to come into Belize, but if you're vaccinated, you still need one to go back to the US. So I do know something just came out today. I've not really had a chance to read that yet. So make sure you check out my newsletter this week, and I'll make sure that I bring that out in the newsletter and let you know the latest on coming into Belize. Kelly saying your tax rate as a Belize resident is 1.75%. If you invest in U.S. business and earn income, how is this taxed? The same percentage? Do you have to pay any U.S. tax in the U.S.? I'm not sure I understand that question, Kelly.
Sounds like Kelly is really thinking about moving to Belize with you, David.
Yeah.
I think he's asking, so for you specifically, since you're a Belize resident and you pay a 1.75% tax, and you invest in U.S. business, do you have to pay U.S. tax? And because you're a U.S. citizen, yes, you do. But if you weren't a U.S. citizen, you would have no U.S. tax nexus, we call it, so you wouldn't have to pay any U.S. tax.
Right. And the tax liability in Belize it depends on what you're doing as far as a job. So if you have a rental property, it's 1.75%. I pay 1.75% for what I earn in my art and gift shop in Ambergris Key. But as a real estate professional, I pay 15%. And it doesn't matter where my money comes from, you have to pay tax in the US and in Belize if you meet that threshold, like Mike was talking about. So, hey, Dave, how are you, sir? Thanks for joining. What would be the best way to minimize taxes on property held in an IBC if it is susceptible to double taxation and is not able to take advantage of the foreign income exclusions. So Dave's in contract to buy a property. I hope I can say that. I won't say where, but it is an IBC, unless he, allows me to. But it isn't an IBC, but it's in an IBC that has no, it's an Anguilla IBC that has no tax jurisdiction in Anguilla. So he is a U.S. citizen. He is a real estate professional. So take it from there. Did I answer any questions?
Well, so as we've discussed before, I hate getting stumped during a live event like this, but I am not an expert with IBCs. I don't have a lot of experience with it. My understanding is that at least the IBCs that I've seen and had experience with, they were taxed as corporations. There may very well be an election you can make to have it taxed as a pass-through. I'm not sure of that, but that's definitely something you'd want to look into and see if that's possible. If you can get it taxed as a pass-through, then you don't have to worry about the double taxation, and you can pass through those real estate deductions to your other income streams so that you can offset them with, if you get the bonus depreciation on the property you're buying this year.
Yeah, and that's my understanding too, Dave, is it's a pass-through corporation, or what I call a holding corporation. It's just hold, nothing is owned. So you can own the shares any way you want. But the only thing that company owns is a title to that property, or shares to that property. So it's not actually creating a business, it's just a holding company. Does that matter if it's a holding company?
If it's just a holding company, and basically so it's collecting and allocating or spreading any income it earns to you, then it should maintain the exact same character and you should pass through.
Yep.
But apparently the ones I've seen did make an election to be taxed as a C corporation in the US. And again, if you can avoid that, then you're golden.
Right. So we'll get an IBC pro on here too, and talk about that as well. So Jeff, if my self-directed IRA owned property and paying tax in Belize, is that credible towards my own personal income tax in the US, or is that not credible as it is owned by my self-directed IRA? I know that answer, but Mike, you can take that.
So the great thing about IRAs is they don't pay tax, but one of the sad things about IRAs, if you use them to invest in real estate and you could utilize the deductions, is you can't take them. They're blocked by the IRA and it doesn't come straight down to you. So it's the IRA isn't going to pay tax unless it's debt financed and you're subject to UBIT, but it doesn't really need the deductions or the tax credit. That it doesn't apply or applicable in the US because the IRA is not going to pay tax. Now, if it ends up paying UBIT, you might be able to use the foreign tax credit paid. That I don't know the answer to that either. I'd have to look, but it seems to make sense that if it's paying tax in the US and it's paid foreign tax, I'm sure there's a good argument can be made that it can be, you can utilize the foreign tax credit. I don't know that for sure. I'd have to look into that.
Yeah, and we can talk to a custodian of some sort, but it does have to pay tax in Belize because it's earning property, but everything is paid, all the tax or all the expenses is paid. My understanding is from the self-directed IRA, and any income goes into that self-directed IRA. So it's not coming out of your pocket per se. Matter of fact, I have a client that owns a property in a self-directed IRA, and they have to get repairs done on it. And we're trying to figure out now how to do the repairs because they can't pay for the repairs out of their pocket. It has to come from the IRA. So, Jared, go ahead.
I was just going to add, if they're able to, and they meet all the eligibility requirements to make an additional contribution to the IRA, then they can make a deductible contribution, assuming it's not a Roth IRA. So they would contribute more money into the IRA, and then the IRA could use that money to pay for the repairs.
And another plug for the EQRP because you can put more money in your EQRP than you can in a self-directed IRA.
A lot more.
Yeah, a lot more. So Jared's asking, can I do a 1031 exchange out of property overseas? So I know that question, but we'll let Mike
Well, let me see
that.
what you think, David.
Okay. So my understanding is a 1031 or a property in the U.S., you can do a 1031 in the U.S., of course. It's done all the time. If you own property outside the U.S., you can do a 1031. You cannot do a 1031 from the U.S. to Belize, but you can do a 1031 from like Germany to Belize. You can do one from, let's say, Nicaragua to Belize, or vice versa.
And I agree, that's been the understanding of the law. However, right now there's a tax court case where someone's challenging that. So it was a U.S. business was sold, the foreign business was bought. The whole 1031 idea and concept is exchanging one like kind business income producing asset for another. And I don't think it's fair that they don't let you go cross border because it's the same business. Just because it's in a different country doesn't make it a different type of business. So I'm really excited to see what happens in that tax court. It's in the Fifth Circuit, which is a very taxpayer friendly circuit. And I suspect, although I can't read the future. I wish I could, because then I'd be living with David right now in Belize. But I suspect that might change in the near future if they don't get rid of 1031 exchanges, which is also a possibility in the next year or two.
Very good, very good. So again, we got about 10 more minutes, so keep the good questions coming in. And Sarah, if you can put in Mike's contact info and everything, so people can have that. If you've enjoyed his answers, if you are looking for a CPA, they do bookkeeping as well. Mike, kind of talk about a little bit about what's your specialty. I know it's real estate, but I know we talked the other day, you have a fireman as well. So kind of go over what kind of clients you can take or are willing to take. Does it matter if they're in Texas or whatever?
Yeah, it doesn't matter where you live. We have clients literally all over the world. We want clients that we can add value to. We do charge for our services, and we sleep a lot better at night. We have much happier clients that they hire us, and we save them more money in taxes than they pay us. So if you just have a simple 1040, an IRA, mortgage interest, we're happy to do your tax return, but I don't think we're going to add that much value. Or really add value is if you own businesses or you've got some very interesting type investments. What we try to do is work with our clients proactively, meaning instead of just waiting until after December 31st rolls around and ask you for your information, it's really too late for us to do any tax planning at that point. We have to report the numbers the way that they came to us. We can report some on better lines than others. There's still a few things we can do, like recommend a cost segregation before we file the tax return, but we want clients that are willing to work to partner with us to minimize their taxes throughout the year. So if you're buying an investment property or you're about to buy a VRBO or a short-term rental, that would be the time to reach out to us, and that's where we can really add the value. Or if you're getting into syndication or creating a syndication, that's where we can really help you out. We're a full-service accounting firm. We do everything except audits, financial statement audits and financial statement reviews. You have to be independent of your client, meaning you can't really consult with them if you're independent, and we don't want that. We want to be partners with our clients. So we have full-service bookkeeping. We do turnkey bookkeeping for a lot of our medium-sized businesses and smaller businesses. We just train them how to do the bookkeeping and then review it once a year, make sure they're tracking it right. It's very important that people have up-to-date financials so we can do the tax planning in the fall and recognize where there might be some opportunities to make a few changes before the end of the year to save in taxes. So that's what we do. We have people in every line of business out there. It just so happens we've grown a lot in our real estate tax practice, and I love real estate tax, and that's probably why we get a lot more real estate related tax. I do, if you're okay with it, David, I saw someone asking a question, I think it might have been in the chat, asking a little bit more about what the real estate professional was and what the benefits are.
Cool.
Okay, so the benefits of being a real estate professional if you have a long-term rental that you can generate a net taxable loss in, and you can use that loss to offset other incomes. You could offset your W-2 income or income from any other source or any other business. If you're not a real estate professional, and again, it's long-term rental property, meaning the average lease is greater than 7 days, then you can't utilize those losses to offset anything else because you're considered passive in the activity. You can utilize it to offset other passive activities if you make the right elections on your tax return. But again, the way Donald Trump avoided paying any taxes is he qualified as a real estate professional and reduced all of his income from other sources, assuming he had some. I guess we don't know that for sure. So assuming he had some, he reduced it by having that real estate professional designation and using the depreciation. A real estate professional is someone who spends at least 750 hours a year or more in qualified real estate activities. And those things are what you would think they are. Being a real estate broker, real estate construction, real estate operations, renting and long-term properties, managing them, all those. The one rule or the two hurdles are you have to spend 750 hours yourself. You can't combine it with your spouse. It has to be your hours or one of the spouse's hours. And you can't spend any more time on any other professional activity in the year. But again, there's that other carve out. If you can't achieve that, then you do vacation rentals and short-term rentals, you could potentially get the exact same benefit of net losses to offset other streams of income if you materially participate, which is a lot easier to do. Spouses can combine their time. The real safe harbor one is 500 hours. You spend 500 hours a year on vacation rentals. The next most safe harbored one is spend 100 hours on it and record that and make sure no one else spends more time on that project than you do and track the time. Then you also qualify as a material participant. And if the lease is for under 7 days on average for the year, you can take that, whatever taxable loss you can generate and offset other income sources.
Very good. Thanks a lot. And we were having some technical difficulties on the poll, so they are in now. Please vote. It helps me know what is your interest. And one of the winners that answers the poll will win a 1 ounce silver eagle of some sort. So thank you for that. Mike is asking about opportunity zones. You want to give a brief what your thoughts are on opportunity zones? You know, when they were starting out, it was, you know, everybody was talking about opportunity zones, and now you kind of really don't hear about it.
Yeah, because they had a kind of a time expiration. So the deal is in 2026 was the cutoff date of when you had to own properties for a certain amount of time. If you owned them for 10 years or longer, if you invested in an opportunity zone, by the time 2026 came out, the end of 2026 came out, you could potentially have deferred recognition of any gain whatsoever. Now you can still invest in an opportunity zone, but you can't make the 7-year holding period to even avoid recognizing 10% of the gain. You'd still have to recognize all of the gain in 2026. You can defer the gain to 2026. I'm not sure that's a great idea this year because we are pretty darn certain income tax rates are going to go up and get higher. So I don't know if you want to defer the income until 2026 when we potentially have 50%, 60% income tax rates. But I think that's why the buzz has died, because of that little time expiration at the end of it.
Gotcha. Wow, man, that hour went by fast. Mike, thank you so much for joining us again, guys. If y'all are interested, we put Mike's contact info. If you didn't see it, please reach out to me, and with Mike's permission, I'll forward his contact info.
Absolutely.
Definitely, I even learned some stuff today, and I hope y'all enjoyed it. And until next month, I'll put out the dates in this week's newsletter for next month, based on some of the polls, the dates and times, based on some of the polls that was reached out today. And our next one is scheduled for June 10th. Sarah just told me. So thanks again, and hope to see you soon in Belize. And Mike, thanks again. Sarah, thanks again. And y'all have a good evening.
You too. Thanks for letting me be here.